Hey guys, um, so today I'm gonna disable my ad block because that's what they want. um, yeah, so today I'm gonna share with you guys a website that a lot of you know, FINVIZ, stock market plethora of information kind of website. Um, a lot of people use it for the stock screener, which is what we're gonna go and teach you guys probably the most basic of the basic when it comes to screening for stocks, finding potential winners that you want to include into your portfolio, and kind of give you guys um, my take on how I screen for stocks. Um, you know, I don't know what I'm going to find, but hey, let's see if I can teach you guys something. So the first thing what we're going to do is um, just real quick to start off, the mindset that I have, which might be different from other people, is kind of the value investors type mindset, where you find companies that are undervalued and you hold them for a period of time, um, so it levels off to where their intrinsic value should be. And value investors look for stocks that are undervalued below their intrinsic value that have a margin of safety. Um, and so, yeah, let's get on with it. So, the country, I'm going to do US only. Um, US only because we have one of the most robust economies in the world. People from all walks of life come to our country to do business, to trade, and they want our business. So, country USA. I don't know if there's Singapore in here. There is. I'll make another video on Singapore. Singapore is one of the most phenomenal foreign countries to invest in, but we'll talk about that another time. So we're gonna go to country. We're gonna select USA. The next thing we're gonna do is we're gonna look at PEG ratio. Now, PEG ratio, according to FinViz, is a ratio used to determine a stock's value while taking into account earnings growth. So what that basically means is how profitable is a company, and while that profit is churning, how is it being used for earnings growth? Um, and so we want a low PEG to indicate that we want to find companies that have low stock value while their earnings are high. All right, so we have those two things. Now, the sales growth the past 5 years, and we're going to do EPS growth past 5 years. We're going to do over 10% for both. Why is that? Because we want to know. I don't care about today. What I care about is the next 5 years and the last 5 years. How profitable were you the last 5 years? If you weren't profitable the last 5 years, chances are slim to none it's not going to be profitable this year, the next year, 5 years from now. So we want to make sure that they're at least profitable over 10% in the last 5 years in both sales and EPS. And I wasn't paying attention, but I'm pretty sure we went from over 7,000 to 171. The second thing is price to book. We want that under 2. The reason for that, we go here, it's a ratio comparing the stock's market value to its book value. In essence, that's one of the key components to finding intrinsic value, that calculation that Buffett loves to use, and other people like Seth Klarman and David Katz as well, probably. Um, the other thing, long-term debt to equity. Okay, this is basically saying how much debt do you carry over year from year and how much of it do you have? So, what I like to see is if a company is profitable, I want them to have debt under zero point 0.5, which means for every $1 they make, they owe less than 50 cents of that dollar towards debt. Um, and, if you go over, it's just adding to that. So I like to see low debt. Um, let's see here. The PE ratio. Um, because it's COVID and COVID it has a way of, I guess, messing a lot with PEs and valuations because companies over the last years have grown significantly. We're going to set it to under 25. Um, Under 25, normally I would do 15, but until valuations start mirroring the actual price of the stock, we're going to put it under 25. So we got EPS, we got sales, we got low debt, country USA, peg under 2. Let's see. We could definitely screen for stocks with over 300,000 shares that are traded as well. And so this is what the screener today has come up with. And as you can see, there's a lot of financials. Buffett likes to stay away from that, from banks. So we have Marine Max, Pulte Group, which is home builder, Lennar, another home builder, Stride. Let's see. Never heard of Stride before. Okay. And the nice thing about FinViz is they tell you all of the things you need to know. The earnings per share growth this year was 183%. The next 5 years, or the next year, it's going to be between 15 to 18% for 5 years. The past 5 years was 49%, which is really good. And EPS quarter over quarter was 109%. That's very good. They got 0.42 on the debt, which is fantastic. Their performance this year was 71% return, so that's not bad. And then here, even though a lot of people haven't initiated coverage for this year, Morgan Stanley and Citigroup, Citi is saying that, hey, you need to buy this yesterday. They're putting a price target for 60. And then obviously you could see some insider trading going on. So a lot of people have sold their shares, probably because of the fact that it's gone up 71%. So this could be a potential LRN. So what I'm doing right now is I'm making a list of potential companies. So Stride Inc. And this is a consumer defensive. They're in the education business. And I've owned builders since COVID, so I'm not going to really dance around with them too much. So obviously you can see financial banks. Banks are incredibly huge component of this. So just gonna kind of see where we are when we play around with the screener. And so I set the sales growth from 10 to 5, EPS growth from 10 to 5, but then I put it for the next 5 years growth of over 15%. And we have a lot of different companies that come into view. We have a Motor Car Parts of America, insurance, some industrials, builders for sorts again. We have a technology company called WidePoint, very low volume. Low volume can contribute to a lot of things. Maybe the stock price, has gone down 90%. uh, you know, I get that. I mean, they have no debt at all. They think that so the EPS growth was 30%, but then, and this is why it's important to do research, their EPS quarter over quarter is down 139%, which is very, very bad. No one's covering the stock, although it looks like some people are pretty bullish. Acquires IT authorities. And then you can see some insider trading going on. And so you kind of just need to play around with the stock screener. I made a couple value screeners. You could take a minute to look at this. This is kind of like a traditional Buffett style screener. It goes over operating margin. I had to put it to USA. He doesn't include PEG, but he likes price to free cash flow, return on equity, return on debt. Return on equity is a very important one. EPS growth, positive, net profit margin over 10%. And if we sort it by volume to kind of weed out the ones we don't really want to look at, maybe we just go to this first page. There's technology, healthcare, all these companies that, Williams-Sonoma, LPX was a company that I was looking at a lot when COVID happened, but I didn't. But as you can see, I mean, this stock just rallied, and I wish I made a video about them, because I found this when they were like, it said the high was 21, the low was 16 or 13. Yeah, I mean, I saw them when they were about $14. So you kind of just have to play along with this. But this screen and the previous screen would kind of be a good way to start looking for companies that are undervalued, that have a good track record, that won't need help from people. And that way you can start to kind of digest how these companies are doing, going into their financial statements, looking at if they're a good company or not, and possibly finding a good, solid company that you can invest in. So I know this video is probably not the best, but if one person likes it, I'm good with that. So I hope you all have a wonderful day, and we'll talk soon. Take care.